Welcome back. We're in conversation with the new kid in the block, Helios Mutual Fund, and I have with me Sameer and Dinshaw. You always said that globally there are only three sectors which have made lots of money, right? There's consumers, and not consumer staples in that sense, but the larger financials and tech. I mean, of course, tech I'll get to in just a bit, but let's just start with days. Let me just start with consumers. Is that going to be kind of a sort of
broadly the research
anchor sector in that sense?
Yeah, it is one of the things, but our research guys like it. Also, they are not working in a vacuum. We've had a history of a philosophy, so that philosophy also says which kind of themes we like, which kind of managements we like. And so to make sure that the Helios India guys, because the senior guys are all the old guys, so they know it, but just as an organization and for new analysts joining and people who may have joined recently, so I put some 30-odd page note on how to invest kind of thing. And that note is going to be made public in the next 2-3 days. So everybody can read it. If they can do it themselves, please do it. Otherwise, you can put it in our fund. But we will tell you exactly the way we do it, or the way we think about investing.
And in consumers across the board, one thing which we've seen, and I think what you alluded to as well, I mean, there is a fair bit of wealth in all parts of the country, wherever you travel to, right? So premiumization across sectors,
everywhere,
the higher end basically is what is doing well.
Unorganized to organized, premiumization, brands, because people are buying online, that also leads to a little bit of, not premiumization, but leads to organized guys, because only those guys will go. So in every angle you can say there's a little bit of upgrading of the...
So consumers at the upper end, then sure, right?
Finance and consumer.
Within consumer.
Within consumer.
Yeah, the upper end, yes.
Yeah,
Preferably now. But it depends, after some time maybe the rurally oriented might turn out. But philosophically, consumer of any kind is good. But currently, the richer consumer is doing better.
And looks like that trend will continue. Maybe the lower segment also picks up, hopefully it does. But at the upper end, it doesn't look like.
So the upper end is always there, and the lower end depends on factors and jobs and rains and so many other things. So it depends on stocks. If they've fallen a lot or not gone up a lot, you may add. But you're absolutely right that the rich are unaffected by many of the day-to-day issues, and so mostly they tend to continue to consume, whether it's the Mercedes cars or bags or whatever.
And preferably buying through Landmark.
If they want, yes, they can. We have no problem with that.
Okay. Now, the other thing is financials, which is the big theme. And you guys have spoken about HDFC Bank being the big one there. Although that is a sector which is recently, because the timelines are very long, has done very well for a long time. Recently, it's kind of been, returns have been flattish, poor.
Which is when you are supposed to buy them.
Yeah.
So we hope that in the mutual fund, whatever these guys decide to buy it, but I know that these stocks are rated well within our system. Yeah.
Any thoughts, Dinshaw?
So I think our feel is that this may be the sector which may be waiting in the line. I mean, as in, you've seen a consolidation happening in this sector for a while. And as I said that whenever GDPs are driven by consumption, right? And these guys are the financiers of that consumption. Plus, they need to finance the capex that is needed for the consumption. So there's a double whammy for these guys. The only overhang was that probably the interest rate cycles are peaking out, and that's why the NIMs may get compressed. But I don't think that's the biggest story. The biggest story is credit growth. And that is what is kicking in today. In fact, this quarter also, supposedly, we're looking at a mid to high teens kind of credit growth kicking in for the banking sector. And that's where the re-ratings happen. And that's why we feel that this is the sector you need to be in.
This is the sector, consumer and financial. IT services now, that's the interesting one. You've stayed away, and rightfully so. And numbers are showing guidance cuts galore. But you think it's the pain is here to stay for a while?
It is here because if you are telling us publicly, I mean not you, whoever that we are not hiring, that we are not going to campus, and we were always made to believe that it's basically a people arbitrage, person arbitrage. Second thing is, if you say that the clients are not willing to give business now, but they are promising a lot of business in the future, that means that business can't be the same. Imagine going to a company and the company says, I have no business for you right now, but here take billions of dollars for next quarter. That means the business for next quarter is not the same business as the business that which these guys only have named it leaking bucket or whatever, all these very good names. Yesterday we saw actually on your channel only an interview where one company was saying we have 15-day visibility. Now, if the company has 15-day visibility, why am I trying for a 2-year visibility? So the point is that because other stocks are doing well.
But that same logic of banks, which you said that now is the time to buy, does not apply for IT?
No, because those stocks are up 15-20%. Tell me if these stocks companies had actually delivered good numbers, how much were they supposed to be up this year? They were supposed to be 40%. All these stocks, not all, literally every, but broadly all these stocks are up as if they've not had a problem because many of them are up 15-20%.
IT stocks?
Yeah.
Okay.
So if they'd actually had good results and good guidance, were they supposed to be up 50% this year? No, normally these big well-known companies broadly will go up 15-20% in a year, but here they are going up as if there was no problem, and leaving out the top 2-3 names. So that's why we don't believe it is the case, but also because the money is not lying in a bank that we haven't spent on IT. It is in some other stocks, and those stocks are doing well, so there is no compulsion to seek right now. That's
right. I'll come to a few other sectors in a bit, but let me just talk about the market overall as well. You guys are launching the fund. The fund NF opens on 23rd of October.
Flexi Cap Fund.
And you will get handed money.
And we would like you to invest in our fund.
Absolutely.
You are allowed to invest in mutual funds.
No, but you will, and inflows will come in and you'll have to deploy. At these market levels, is there is that some, and you will deploy, but I'm just saying that you would have liked it lower, you would have liked it, of course, you do it when you do it, but just your thoughts.
No, but actually the levels are not very off because if you look at last 5 years, 10 years, 15 years, 20 years, 25-year returns of the market, in rupee terms, they are in the range of 13, 14, 15% per annum. They don't come evenly, but over those periods. So if you look at the market now for this year, calendar year, in NSE 500, I think it's up some 12, 13%. So broadly in line with what annualized numbers are. If you look at last year, the market was up 4.4%, NSE 500. So in 21 months, it is up less than what is our normalized number. If you convert it to dollars, because last year the rupee depreciated, 10%. So in dollar terms, a foreign investor has made 5-6% in 21 months. So he also does not feel that he's missed out a lot. So these are the things that the levels are okay. They can be cheaper, but then our current my investors would be hurt. So it's a balance between all the time what you want for the new
Obviously.
And for the old. So it's okay. It's broadly it's not wild that.
But that's the index, right? But broader markets.
No, broader market also, other than some 1 or 2 sectors or sub-sectors and maybe small cap stocks. Because anyway, in a flexi cap fund, 50% or so will be large caps. We have ranged in the past in our PMS and whatever I saw between 40 and 70 odd percent. So 50% is okay because you are saying large caps are okay. So then that 50% we have to buy some mid caps, a little less small caps. Maybe not avoid the category, but avoid those kind of stocks that are up a lot for, if they are up for no reason, which I think many of them are up for no reason.
Do you believe this? Do you it's almost become like a drumbeat saying that large cap, buy large cap. Now is the time for large caps, mid caps. You agree?
Yes.
That is
I
the
agree
case.
because if you see any big cycle, these small cap, when they go up a lot, they go down a lot. And then they get sorted, and then some ones who survive, then they become mid cap. But not, people say, oh, you should buy small cap because they will all become, because all large companies was initially small cap, let's say. All large cap companies were initially small cap, but all small companies did not become large cap or even mid cap. That is the idea.
Dinshaw, your thoughts on this, the broader market and how well it has done? Do you kind of...
So if you look at it, Prashant, the fact is that the markets have gone up based on re-ratings happening. Right? Every single quarter, last 3 quarters in fact, the earnings have got upgraded. There have not been downgrades. So it's obvious that these valuations are holding up because of upgrades happening. In fact, this quarter again, we're looking at some, there'll be sectors, obviously there'll be downgrades happening, but bulk of them, whatever advanced numbers that we're seeing from the analysts, they're looking at upgrades happening. So also, if you look at the valuations, if you look at the last 6-7 years, we are somewhere close to the average. In fact, in certain cases below the average, but 10 years, we're probably one standard deviation away. So it's not too overpriced a market. But our belief is that we're in a good space today, given that the growth is built in and looking forward.
When you guys were launching, was there a debate about active versus passive?
Yes, there was a lot of debate.
Tell us a little bit about the inside track.
Anybody who would have debated on the other side would have been fired.
So there was only
nobody debated on this. Because we are fund, we have not come from a background saying that we are desperate to do some new business, so let's go into financial business. We have been active fund managers fund managers or research heads or whatever.
Correct.
Even the other founders were all from Alliance, the old, everybody is active. We understand the power of active, and we have done well by being active. So not only we are not doing it now, we are mostly not doing it for at least 3-4 years after that, who knows.
But we will see more schemes, etc.
So we
coming through.
we don't want to do one fund and we don't want to do 18 funds. So we'll do 4-5 funds.
Okay.
Because, it gives more growth opportunities within the firm, so more people join and then they add value. And second is you need a certain bouquet for the distributor also, so that when you are tying up with great difficulty with some good distributors and he has 4 things that he wants to buy, you want to say, okay, we have them.
We can offer.
But we will do only those where we believe. That's why we are not doing every category, every sector, every month like some funds do.
One of the things which has happened, Shaw, and we were discussing this earlier, the kind of companies which are coming to the market now, I mean, they're actually completely new business models. The opportunity did not exist even 2 years ago, right, in many cases. And then that throws up opportunities and challenges because there is nothing to benchmark it against and think. Any thoughts on that? And,
so, Prashant, as I told you that we have this 8 factor of rejection, and that helps a lot, right? So one recent company which came up and it got rejected on the promoter level. That's the 4th factor of rejection. Very exciting industry. It was in defense and it was supplying to. It had a huge order book. I won't talk about the name of the company, but then listing also was very good.
Yeah.
But then the numbers came out and things came out in the open that, okay, fine, there were certain issues and the stock is down half of what the listing was. So that helps in a very big way. These factors of rejection are universal across industries. They're sector agnostic. So you can work on those and obviously that helps.
In terms of new models, we've had Paytm, Zomato, which we both bought. So
that's
those also are new models. Now every day, we didn't buy, but there have been many new. I agree. There's been airport facilities management,
Correct.
they are not facilities that lounge management. There's that. There've been many companies.
I mean, even the auto dealership we're talking about. I don't think we've had another.
Yeah, correct. No, but those actually, I didn't think of that because that business was always there in the private space. In the listed, it is new. So at least that business is easy to understand. But these Paytm, Zomato is even more complicated to understand as a business, and we got both of them right.
Well, gentlemen, I wish the both of you all the luck in the world and your teams all the best.
Thank you very much.
And we look forward to the launch.
Thank you. And we look forward to all you guys investing in our fund.
Thank you so much.
Thank you.
Thank you.
Thank you.
Thanks so much.
Thank you.
Thank you.